What is the crypto market most likely going to look like in 2023? Bull market or bear market? If you want to know my answer to that question, pay close attention to this video because I'm going to provide overwhelming evidence to state my case. But before we get started, I have to let you know that this is not financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only. Always do your own research. So in this video, I'm going to provide overwhelming evidence as to why I think we're going to be in a bear market for most likely most of the year next year. Going to go over when I think the bull market is going to return, how I'm going to identify that we're back in a bull market, my strategy to navigate through the bear market, and then my strategy to navigate once the market turns back bull. And at the end, I'm going to show you an update on some of my yield firms. Let's start it off. So I think 2023 is most likely going to be a bear market. So let's go over the reasons. We're in a semiconductor crisis. Semiconductors are in pretty much all of our electronics, missiles, cell phones, cars. We're having an energy crisis. Inflation is still under control. And I actually want to go over a few things that Jeremy Powell said in his last speech that I think people just kind of took out of proportion because people want the bull market to be back. So this is a text from Jeremy Powell's last speech that he gave, I think, last week? I forget the day. And just because he hinted that the rate hikes are going to slow down in December, people took that to say, oh, the bull market's back on. But I want to go over everything else that he covered just to shed some light. So I'm not going to read the whole thing, but a few points he said. It will take substantially more evidence to give comfort that inflation is actually declining. By any standard, inflation remains much too high. The Federal Reserve's goal is to get inflation to under 2% or to 2%, and we're nowhere near that goal. Second thing, for starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There is considerable uncertainty about what rate will be sufficient, although he's talking about what federal funds rate will be sufficient, meaning how much they have to raise it. He doesn't know. Let's continue on here. Although there is no doubt that we have made substantial progress, raising our target range for the federal funds rate by 3.75 percentage points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. So he's saying here that we're going to continue to raise rates. And as long as he's continuing to raise rates, we're going to continue to be in a bear market. Like, it's two things you don't fight. I always say, you don't fight the trend is your friend, and you don't fight the Federal Reserve. If the Federal Reserve is printing money, money is cheap, people are going to borrow money for cheap, that money is going to find its way into asset markets. If you're in asset markets, you get to ride the wave. Rising tide raises all ships. But if the opposites happen and he's sucking that money out of the system by making interest rates high, the cost of companies' debt who've been borrowing for cheap for the past decade is going up. It's going to cause massive deleveragings. Deleveraging just means the act of selling one's assets to cover one's debt. And then that's also going to play into the whole unemployment thing that we're going to talk about. Because if you're having to pay off debt, you're not going to be able to afford to keep all of your employees. And that's why we're seeing these massive layoffs that we're going to get into. So let's move into the next point. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. So basically he's saying that even though they've been raising rates, inflation hasn't really started to fall off yet. It's a lagging indicator. So just like when the Federal Reserve turned the money printers on, we didn't see inflation get to high levels into after. Like, it takes a while for these things to manifest themselves. Just like you plant a tree and you have to keep watering it before something sprouts out the ground. You have to print a lot of money, and then inflation will catch up after. And then once you start to raise interest rates, inflation will also start to slow down after. These are lagging things, so it's going to take time. Okay, let's move on to the last point. And this is the statement that he made out of everything else that we just read that people heard and was like, oh, the Federal Reserve is taking their foot off the gas. They're going to pivot. They're going to start back printing money, raising rates or lowering rates. The bull market's back on. No, it's context. Monetary policy affects the economy and inflation with uncertain lags. I just talked to you guys about lags. And the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. He said may come as soon as the December meeting. So let me summarize this again. Jeremy Powell is saying that they're going to start slowing the increases because he realized that he raised rates from, 0.4% all the way up to 3.3%. 8.75%. That's pretty high. And we can already see that, we've been in a recession despite the White House trying to change the definition. He realizes that this is a lagging indicator, just like I told you that printing money was. So as to not completely destroy the economy, they want to slow the rate increases down because he expects inflation to start coming down. It's cause and effect. Every effect has a cause. Every cause has an effect. It's the same thing with markets as it is with life. They're trying to just slow the rate increases down because they've already raised it a pretty high amount. Now I want to talk about one more reason why I think they're, pulling the lever back on the rate increases that not a lot of people are talking about, and that is decreasing the Federal Reserve's balance sheet. So if we look at this chart here, this is the United States Central Bank balance sheet. As you can see here, when COVID happened, they had to print a lot of money so that the economy just wouldn't fall into a deep recession. To be honest, if they would have just let the economy fall into a recession, we'd probably be better off now, but 2020 hindsight. So as you can see, at the peak, the Federal Reserve's balance sheet was 8.9 trillion. And just to summarize, a balance sheet is a company's or an institution's, in this case the Federal Reserve's, assets and liabilities. It's all the assets they're holding with all of the debt that they owe as well. So when they had a balance sheet of $8.9 trillion, pretty much $9 trillion, that means they had a lot of assets on their balance sheet. So where did these assets come from? Well, when COVID happened, they were literally buying assets to prop up the markets because there weren't other buyers, okay? Because, business were shutting down, people were getting sick, couldn't come to work, all kinds of reasons that we're not going to get into. So they were buying mortgage-backed securities, junk bonds, even stocks. So now they're having to offload these assets off of their balance sheet. So I believe that they're slowing the interest rate hikes down so that they can start offloading these assets from their balance sheets. Why can't you do both at once? I'll tell you. If you're raising interest rates, I just talked about how it's making the cost of money more expensive. But now, let's say you're dumping all these assets onto the market. Well, now you're going to drop the price of all of these assets, okay? So now, not only are companies having to pay more in their debt, but the assets that they have in their treasury are going to become worth less and less because the Federal Reserve is dumping them onto the market. Like supply and demand. Like for any market to see all-time highs, two things have to happen. You have to have an increase in demand, aka new pool of buyers that enter the market for the first time, because historical demand isn't going to push prices to new highs. And then you have to have a supply that can't meet that demand. That's to see all-time highs. To see all-time lows, you have to have an increased supply and a shrinking demand, okay? Because now you're going to have more products and services with less people bidding on them. And that's exactly what's happening right now is they're offloading these assets from their balance sheets. So they don't want to just push the economy into a depression because they're raising rates and companies are having to pay more. And then as they're deleveraging and selling their assets, they're able to get less and less from them. Like the Federal Reserve doesn't care about how much money they're making. So that's why they're just offloading them slowly but surely. So we have to get this way down. They offloaded around 500 billion. It went from pretty much 9 trillion to 8.5 trillion. So they've offloaded 500 billion, but they still have a ways to go. Now, we just talked about this. The next reason why I think we're still going to be in a bear market is because unemployment is going to continue to rise. And one company's spending is another person's income. If you don't have people working and making money, they can't spend money. And if they can't spend money, companies can't get paid. And if companies aren't getting paid, they can't pay employees. And it's just a big cycle. Hopefully that makes sense. So let's go over, and this is another thing. The Federal Reserve, Jeremy Powell, he said he's looking at unemployment rates as a gauge of inflation. What that means in layman's terms is, hey, I need to see unemployment go up before I can start being more dovish and lowering rates or printing money or whatever the case may be, because he knows that if people are laying off their biggest asset, which is their people, he knows things are getting tight. And the whole point of him trying to lower inflation and raise rates is so that he can kill off demand, so that supply and demand can reach that equilibrium, that balance, okay? Let's go over some unemployment data. And I have the data right here, so I'm going to be looking at my screen because I didn't just memorize unemployment data for you guys. I love you, but I didn't. So we already heard about Elon Musk and Twitter cutting a lot of jobs, and they're like pissed off over there. Amazon laid off a lot of people. I don't have the numbers. Meta laid off 11,000 people. Lyft laid off 700 people. Stripe laid off 1,100 people. Microsoft laid off 1,000 people. Coinbase laid off 1,100 people. Shopify cut 1,000 jobs. Snapchat cut 1,000 jobs. Netflix cut 450 jobs. Robinhood laid off 31% of their staff. And Tesla laid off 10% of their salaried employees. So these are some of the biggest tech companies in the world, some of the most profitable companies in the world, laying off large amounts of people. So if you think they're doing this, what do you think's happening to the medium-sized business and the smaller business? It's a lot worse for them because a lot of times they get their revenue from these larger companies, okay? So hopefully that makes sense. Now let's talk about the next reason why I think this bear market is going to continue, and not a lot of people are talking about this, and that is Apple. I think they're going to miss their quarter one earnings. Why is that? So just to give you some context, Apple generated $360 billion in 2021 in revenue. 52% of that revenue came from the sale of iPhones. And right now, you can't even order an iPhone for Christmas. Why is that? Because people in China are protesting over the zero COVID policy. They're trying to lock people down again, mask, all this stuff. Like, people are getting beat on the streets. Go on Google and look it up, and you can see it for yourself. But I think they're going to miss their quarter one earnings because their quarter one earnings show what they made pretty much in Q4. And Q4 Q4 is Apple's most profitable quarter because it's Christmas time. People want to buy the new iPhones for Christmas. Now they're not going to be able to do that. And if they don't make their quarter one earnings, I think their stock is going to drop substantially. You remember when Facebook didn't hit their earnings, their stock dropped over 30% in 7 days? It was the largest drop in Facebook's history. What do you think is going to happen to Apple? On top of that, they're in the middle of the largest stock buyback in history. They can't sustain that. So when that slows down and they don't hit their earnings, I think they're going to drop. And that's going to send the S&P, in my opinion, one more leg down. If you look at this, Apple and the S&P are very, very correlated. Like, the charts look very, very similar. Why is that? The reason is because Apple is the most valuable technology company in the world, and they hold the largest weight in the S&P. Okay? So when when Apple drops, the S&P drops. And when Apple tops out, the S&P tops out. And I'm going to show you evidence of this. So if you go back to October 1st, 2018, you see the market topped out on the S&P. Now let's go back to October 1st, 2018. You see the Apple topped out, okay? Boom, literally the top. Now if we look at another top here, this was Monday, March 2nd of 2020, another top out here. If you look at the most recent top, you see that was on Monday, January 3rd of 2022. If we go to Apple, Monday, January 3rd of 2022, topped out again. And lastly, if you go to, this is going back to 2009, when Apple bottomed out, the date was March 2nd. Monday, March 2nd of 2009. Let's go to Monday, March 2nd of 2009, the literal bottom. So mark your calendars for the earnings call because I think it's going to get us into this accumulation box. And as you can see, we're still in a strong downtrend, making lower highs and lower lows. And now we just had this pump setting us up for a big old dump here. And I think we're going to come in and around this area. And then that's when the buying is going to start. So I think if Apple drops, that'll push us even deeper into the recession. And I think will be the catalyst to kind of put us into the bottom. And that's for just traditional finance. Now let's get back to crypto. When do I think the crypto market is going to bottom out? When do I think the bear market is going to come back? Well, this whole fiasco with FTX still isn't fully unraveled. And we don't know if Genesis is going to go bankrupt. Like, yeah, they have a lot of different companies. Grayscale Bitcoin Trust is generating them a lot of money annually because they have 2%, that 2% management fee. But after seeing all these companies go bankrupt and how they all lend to each other, I wouldn't be surprised if they did. Like, I'm just expecting anything. If we go back to 2008, I have these lines marked on here. This represents when Bear Stearns collapsed, and this was March of 2008. This line represents when Lehman Brothers collapsed, and that is September of 2008. And this represents the bottom. We didn't see the bottom until March of 2009, 6 months after. So remember how I was talking about lagging indicators? It's the same thing with this. When a company goes bankrupt, there's a process that has to happen. People have to get paid back. Assets have to get sold. And once those assets get sold, that gets dumped onto the market. And you remember what I just told you guys about supply and demand. That's what causes the contagion. Like, it's a contagion effect that still has to play out. So if we look at Bitcoin, it's the same thing. As FTX has to, sell off his assets along with Voyager and BlockFi and any other company that announces bankruptcy in the next few months, which I wouldn't be surprised if they do, exchanges, lending platforms, it's going to cause more contagion. And I also wanted to show you this pattern here. And a lot of people are like, oh, it's just a chart. You want to look at sentiment, like the sentiment is reflected in the charts. So if we look here, you see how this pattern, and I've talked about this pattern looks just like this pattern. We saw resistance going down, 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 and the support was just a straight line, and we saw it drop. We're seeing the same thing here. Resistance going down, 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 support, straight line, and we already saw a piece of the drop, and I don't think it's done. So if we look here, from this line, we dropped 45%. Now, from this line, we've only dropped 18%. If we drop 42% from this line, that puts Bitcoin at just above $10,000, pretty much $11,000. I think at the minimum low that we'll see on Bitcoin is $13,000, especially as this contagion continues to affect. If Apple doesn't hit their numbers, inflation's still under control, companies are going to continue to have to sell off their assets, and then it's an effect. So now let's get back to the question of, when do I think that the bull market is going to return? My answer to that, maybe the end of 2023, but I think definitely by 2024. Why is that? Let's go over it. The first reason is because Republicans are starting to take over Congress again. Okay, and I feel like the theme of this video has been things are lagging. So for the past 2 years, Capitol Hill has been controlled by one party, and that's the Democrats. And not to get super political, I'm not a politician. I only follow politics to the extent that it affects my investment decisions. So I know that Republicans are more about lower taxes, capitalism. They cater more to corporations. So now that the economy is in this funk, companies and people are going to want to see markets go back. And it's normally the Republicans that do that. So at the midterm elections, the Republicans won the House. And that ended the Democrats' control of Congress. So it looks like the Republicans are taking back control, getting back in the driver's seat. If Trump gets in or another Republican gets in, then the money printers are going to get turned back on. And I already talked about what that process looked like. Money's going to be cheap to borrow, and it's going to find its way into asset markets, including Bitcoin and crypto. Ever since Elon Musk has taken over Twitter, he has been stirring stuff up, and he is exposing Democrats in the Biden party. Look at this. So Elon, he said, here we go. And he released these Twitter files. So what you're about to read is the first installment in a series based upon thousands of internal documents obtained by sources at Twitter. So if you look at this, and this is on Elon Musk's Twitter, you can go and read this for yourself. I'm just going to go through a few things here. By 2020, requests from connected actors to delete tweets were routine. One executive will write to another, more to review from the Biden team. The reply will come back handled. So these are emails that they received at Twitter. Basically, these are accounts that were flagged for posting bad stuff about Biden, retweeting bad memes. Some of these were even bot or spam accounts, and they were getting deleted. Like pure manipulation. Celebrities and unknowns alike could be removed or reviewed at the behest, I don't know how to pronounce that, of a political party. On October 14th, 2020, the New York Post published Biden's secret emails and exposed based on the contents of his son Hunter Biden's abandoned laptop. Twitter took extraordinary steps to suppress the story, removing links and posting warnings that may be unsafe. They even blocked its transmission via direct message. Like, this is crazy. So it's a lot of other things that he's exposing. I'm not gonna, go into all of it with you, but this is gonna do nothing but put a bad taste in people's mouth as it pertains to Democrats. In my opinion. I don't know, only time will tell. Okay, so now let's talk about my strategy for navigating through the bear market. Not just navigating, but prospering, printing money like we always talk about. I already told you guys my strategy on how I'm getting paid passive income to short the market. In my last video, bear market passive income strategies, I went over how I'm getting paid to buy the dip. If you haven't seen that video, click the description and the link is in the description. But I'm just going to continue to do that. You don't have to be super, super busy. And a lot of people are talking about, dollar cost average. Like, I'm not dollar cost averaging right now. My dollar cost averaging that I'm doing is my yield farming profits. Like, I get to provide liquidity on exchanges, and then I make passive income, and I can take that income to buy other assets I'm bullish on. And it's not like I'm taking the cash that I have sitting on the sidelines waiting for the actual bottom. even though no one knows when that's actually going to be, but we know it's not right now, or it's a high probability that it's not right now. Now let's talk about how will you know that the bull market is most likely back? Let's go over that. Okay, so in order to know like, hey, the bull market is back, you want to be able to identify a trend reversal. And identifying a trend reversal is basically being able to see like, hey, the market went from a bear market to a bull market. And in layman's terms, that means the market went from a downtrend or a consolidating market to an uptrend. And I'm not talking about in the daily chart or the 4-hour chart. I'm talking about on the monthly chart or the weekly chart. That's why they always say, when in doubt, zoom out. I like to start my technical analysis and my market analysis from a big picture and just kind of zoom it in. You know, just like when you're driving somewhere, you want to look at the map to know where you're getting before you get in the car and you're on the little street and then you can only see the road ahead of you. Like, you always want to start from big picture. So let's go back to the 2017 bull rally and bear market. And let's see how you would have been able to identify that the bull market was back on. It's simple support and resistance. You see all these people with all these indicators on their chart. You don't need all that shit. I use support and resistance, and I use the 62 EMA. So if you look here, the market was choppy, moving sideways. It wasn't in an uptrend. It wasn't in a downtrend. But the market turned into a bull market so you have support here, which are floors, and then you have resistance here, which are ceilings. You want to see the market turn resistance into support. You want to see either a large breakout candle. That's less probable, but an even more probable scenario is if you see a break and retest, and it breaks from that ceiling, comes back and tests that ceiling as a floor, and then it prints a big green candle on that floor. I'm going to show you an example of that. So we were consolidating within this range here, and then the market broke above, and then it retested this resistance that it was resistance for since literally May 18th. It was resistance here, 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 here. And these are monthly touches. So you know it's touching it way more as you go to smaller time frames. Now let me zoom down to the weekly chart so I can get a better idea. And boom, you see the breakout in two different candles now. This is the $10,500 level. Like, it's a psychological level. And you know, that's why you want to, and this is why you want to wait for a big green candle. Because if you can see here, it broke above, but you know, it wasn't really a breakout candle. Like, it came back and it almost tested it. It almost retested it as support, but it was a red candle. So that means the market closed lower that month and then went down. And it wasn't until here, but you still can't see the retest, right? You can see the breakout, but you can't see the retest. So that's why you just keep going down and down. So now, if we go back here and zoom in, this is why I use my 62 EMA, because I also like to treat this as support. And again, you want to look at these areas as zones. It doesn't have to click the line perfectly, but we saw it break above, right? And now it tested it as resistance. This is a zone here, right? It tested the $11,000 zone as support. It didn't go back under. And you see this nice big green candle here? That's the breakout candle. And then as you can see, what happened after that, boom. And you know, you don't have to bottom tick and identify the actual bottom. You want to identify the trend reversal, okay? So, hey, yeah, I could have gotten in right here and made 10, 20, 30% more. But the probability that it's a bull market after just seeing this is very low. So you want to just wait for a trend reversal. And that is simply what I just showed you. Turning previous resistance into support with a breakout candle, a nice big green breakout candle. And you want to start on the larger time frames and I don't go any lower than the 4-hour, okay, unless I'm day trading, which I don't do anymore. And just to show you some of my yield firms here, still getting 43% on Radix Ethereum, 19% on ETH USDC, another 25% farm ETH USDC, 52% on ETH USDC, 99% on ETH USDC, 39% on ETH USDC. So just because it's a bear market doesn't mean you can't generate decent returns or above average returns. So what is my strategy for when the market turns back bullish? Obviously, I'm going to start back dollar cost averaging after I identify a trend reversal, but I'm going to start doing something that I never talked about, and that is leveraged yield farming. So you can, just like how you can go into a farm with your assets, you can take out leverage and go into it. And some platforms will allow you to take out the leverage while getting to the pool simultaneously. And it's good to do that kind of stuff at the bottom when everyone's gone, because the likelihood of the market going down even further, aka you getting liquidated, is minimized. Like, people are using leverage at the top when Bitcoin's going up, and they're like, oh, it's just gonna keep going up. And then the exchanges see everyone's bids and the market drops. Like, no, you want to use leverage at the bottom, not at the middle, not at the top, at the bottom. And just to give you an idea as to like what I'm accumulating during this bear market, you see most of the pools I'm in is in ETH USDC. That's because the volume to TVL ratio is the sweet spot. And ETH is volatile, but not so. The ETH volume is high, but it's not super volatile to where I'm losing a lot on impermanent loss. And if it goes down to the downside, I don't mind holding ETH downward. You know, I hope it keeps going down, because once it goes down and it gets to the bottom of my range, I'm going to take it out and wait for it to go back up and rinse and repeat. And then I'll have more money, because once I sell it, I'll just take those profits and send them to another wallet. Whenever there's a bull market, it's always triggered by narratives. We had Bitcoin halving, DeFi summer 2020, NFTs. It's always some kind of narrative. I think the next narrative is going to be real yield protocols that are sharing their revenue that they're actually making with the token holders. And I'm not talking about token inflation. Like, it's 3 ways that you can make money in finance that are real yield: borrowing and lending fees, trading fees from providing liquidity on decentralized exchanges, which is what we were just talking about, and insurance premiums, using your assets to provide liquidity to pay out insurance premiums. Everything else is just token inflation. So protocols like GMX is like the darling of DeFi right now, doing really, really well. And Radiant. Okay, so I'm just accumulating all that through yield farming, still short in the market, getting paid passive income, providing liquidity on Uniswap V3 in certain ranges, generate high amounts of passive income. So when we come out of this bear market, portfolio is going to be looking strong, I'm telling you. So with that, I like to conclude this video. I hope I shedded some light. Let me know if you have questions in the comments. Share this video with someone who you think it could be helpful to. Let me know if you thought I was wrong somewhere. And if you want to be in the know, click the description to fill out the Google form to get into our Know It Alls Discord. We're only letting a few people in. Other than that, I thank you so much for tuning in. I love all of you, and I will see you in the next video. Phew.